shares? Let's get right into it. So, we've got Rabco looking to make a bonus issue on a 1-for-4 basis. That means for every 4 shares someone owns, they get 1 new one for free. Pretty sweet deal, right? Before we dive into the math, how do you want to tackle this? Should we walk through it step by step? Or is there a specific part tripping you up? You got it. Let's start by figuring out exactly how many shares are out there right now. This is the first step, because the bonus issue depends on the number of shares, not the dollar value. Looking at your notes, the share capital is $150,000, and each share is worth 50 cents. So, we have 300,000 shares in total. Now, the bonus ratio is 1-for-4. That means for every 4 shares, we give out 1 new one. We're issuing 75,000 new shares. But we need to know the dollar value of these shares to put them on the books. Does that make sense so far? Yep, you're spot on. Multiplying by 1/4 is the same thing, and it's definitely quicker. Now that we know we're handing out 75,000 shares, we have to find the total dollar value of this issue. We use the par value, which is that 50 cents we found earlier in the share capital line. So the total value being moved around is $37,500. Ready to see how we record this in the journals? Great question. In accounting, when we issue shares, we have to record them at their nominal or par value on the balance sheet. Think of it like this. Each share is a piece of paper that says 50 cents on it. If we hand out 75,000 pieces of paper, the total face value we just gave away is 75,000 times 50 cents. Since we aren't actually getting any cash for these, they're bonus shares, we just need to move that $37,500 from our reserves into the share capital account. Make sense? Sweet. Now let's handle the double entry. This is where we show where the money is coming from and where it is going. Notice we debit the share premium account. In accounting, reserves like share premium usually have a credit balance. So by debiting it, we're actually reducing it. We're using up some of that extra money we had tucked away. Common mistake alert. Some people try to debit retained earnings first. While you could do that, the rule is generally to use up share premium first because it's more restricted. Does the logic of the debit and credit click for you? That's a super fair question. Let's break down the logic of why we use share premium specifically. Think of share premium like a gift card you can only use at one specific store. You'd rather spend that restricted gift card balance to buy your new shares than use your retained earnings, which is like cold hard cash you could have used for anything, like paying out dividends to shareholders. We had $60,000 in there. By debiting it for $37,500, we are simply taking that amount out of the restricted bucket to pay for the new shares. Does that help clear up why we're hitting that specific account with a debit? The final piece of the puzzle, the statement of financial position after the issue. We're basically updating our totals based on those journal entries we just made. Let's look at where these new numbers came from. For share capital, we started with $150,000 and added our bonus issue of $37,500. And for share premium, we had $60,000, but we used up $37,500 for the bonus shares, so we subtract that. Check this out. Look at the total equity. It was $410,000 before, and it's still $410,000 now. We didn't actually gain any value. We just moved it between accounts. Pretty neat, right? How are you feeling about how those totals changed? Exactly. Nothing is the perfect way to describe the change in the total. The total equity doesn't move a single cent. It's just internal bookkeeping. Since we've walked through the whole process, I've got a few flashcards for you to keep this fresh. We've crushed this problem. Do you feel confident moving on to another one? Or should we double check anything here? You got it. Let's lay out the master formula guide so you can see exactly where every single number came from in your notes. First, we take that $150,000 share capital and divide by the 50-cent par value we found right there in the problem description. That gives us our 300,000 shares. Next, we take those 300,000 shares and multiply by 1/4. The 1 for 4 was given in the text right below the table. That gets us 75,000 new shares. Now we turn those shares back into dollars. 75,000 shares times 50 cents gives us the $37,500 value. This is the exact number your notes show for the journal entry. Finally, we add that value to the old share capital and subtract it from the old share premium. Everything flows from those initial numbers in the table. How does that breakdown look to you? For step 5, we just sum up all our updated accounts to make sure everything balances out. We take the new share capital and the new share premium we just calculated and add back the original retained earnings of $200,000. As you can see, the total is exactly $410,000, the same as we started with. It's the ultimate proof that a bonus issue doesn't change the size of the pie, just how we slice it. Ready to move on to the next part of your homework?